topic I want to discuss today is accounting standards. That's right. Accounting standards. The topic I want to discuss is accounting standard. So, accounting standards are written policy documents issued by the expert accounting body in the country. And in India, the expert accounting body is IC. In India, the expert accounting body is ICAI, the Institute of Chartered Accountants of India. Why these standards are important is for standardization. Suppose there are two chartered accountants like Mr. A and Mr. B. If you go to Mr. A and ask to prepare a financial statements, and suppose he gave you that your income is 20 lakhs, you are not happy for whatever reason. You go to another chartered accountant and ask, can you prepare my financial statements? And Mr. B, he gave you 30 lakhs as your income. Most probably you won't be happy. You will feel confused. Like if two people have prepared your financial statements, both should give you the same profit. Then only it is a standardized. Like it happens with a doctor. If you go to a doctor with a disease, he gave an opinion. You go to a second opinion, both should be the same. Otherwise, you will get confused. So for both the people to follow same number, they need to follow same standard and which is issued by the ICAI, the Institute of Chartered Accountants of India. In ICAI, we have many boards. Like for the welfare of and study of students, we have Board of Studies. Likewise, the board which deals with accounting standard is ASB, which is called as Accounting Standards Board of ICAI, will issue accounting standards. Till now, ICAI has issued 29 accounting standards, in which they removed one. So as of now, there are 28 accounting standards as per your syllabus in CA Inter. The standard I wanted to discuss was Accounting Standard 1. AS1. Disclosure of accounting policies. Accounting Standard 1 is disclosure of accounting policies. So, when we say a policy, it is how a person or an organization acts. For a company, their HR policy is you need to come to office at 10 a.m. So, it is their policy, it is specific to them. Likewise, in accounting, companies will follow their specific accounting policies. The definition of an accounting policy is the principles and the method of applying those principles adopted by an enterprise in preparation and presentation of financial statement. So I will split the definition for you. Principles and method of applying those principles. Applying those principles while preparing financial statements. So in accounts, there are many places where more than one type of treatment is possible. Example, for doing depreciation of an asset, you can follow straight line method or written down value method. Both methods are okay. So which method you follow is your accounting policy. So my company want to follow straight line method for depreciation. My accounting policy is to follow straight line method. Another company may follow a different method. One more example is for valuation of inventory you have FIFO, or you can also follow weighted average cost. Which method you want to follow is up to you, but once you follow, that is going to be your accounting policy. Likewise, there are many such areas in accounts where more than one treatment is possible, and whatever treatment you are dealing is your accounting policy. Hope it's clear. So everything is good, but which policy to follow is the question. Why should I follow straight line method? Because it is straight and I like straight? No. So, to select an accounting policy, there are major criteria. Three major criteria for selecting an accounting policy. So, for selecting an accounting policy. The first criteria is prudence, also called as conservatism. You people also can answer. Suppose if a person wrote an exam and he knows that he is going to pass the exam, will he celebrate on the same day or he will wait till the result? He will wait till the result. Yes or no? Great. The same person wrote the exam and he knows that he will fail. He will cry on the same day or he will wait till the result and pray? He will cry on the same day and then he may cry after it. So, generally in life also, in accounts also, if there is a bad news, you recognize immediately. Whatever bad is supposed to happen, you recognize immediately. Whereas something good is happening in future, you wait till the result is coming. That is called as prudence. Suppose I purchased a land worth 10 lakh rupees. Our chief minister announced a metro near my land and this value becomes 1 crore. I will still show it as 10 lakhs only till I sell and I receive the money. Then only I will celebrate and do a party. Till that time I will show it as 10 lakhs only in my books. Alternatively, a reverse happens. I purchased this land for 1 crore. There is a litigation and some companies are moving out of my area and the land value fell to the same 10 lakh rupees. I may be forced to reduce the value of my land in my books based on accounting standards because even though it is showing as 1 crore, its actual value is 10 lakhs. So, bad news recognize immediately, good news wait. So, that is what our prudence concept is telling. Right? The second criteria is substance over. So you need to account for transactions based on the substance of the transactions, not merely on the legal form. Example, I purchased a house by paying a house worth 1 crore rupees. I paid only 20 lakhs and Bajaj Finance has given 80 lakhs. Who is the actual owner of the house? I paid only 20 lakhs, whereas Bajaj Finance has paid 80 lakhs. If you see the legal technique and all, they paid more, so it should be the property of Bajaj Finance. But the actual substance, Bajaj is not going to stay there. I am going to stay. If I give it on rent, I am going to receive the money. And I need to pay the EMI. So even though they paid more money, but still I am the owner of the property. So that is called as substance over form. So it's not merely on the legal form. Substance is important while selecting an accounting policy. Right? And the third one, material. While selecting an accounting policy, you also need to see the materiality of a transaction. For example, asset. The definition of asset generally says any resource controlled by the company from which future economic benefit is derived. For example, I own a mobile. I own this, I can control this, and from which I will get economic benefit. So it's an asset. My pad is also an asset. Likewise, I have a pen worth 10 rupees, that is also an asset as per the definition. But if I keep on adding 10 rupees as my assets, my book will be bigger. So instead I can say any asset worth less than 5,000 rupees, I will consider it as an expense. So by materiality, I can choose certain transactions to exclude, certain transactions to include. So these three things will be followed while selecting an accounting policy. Okay? Anything? Fine. So AS1 says all the accounting policies followed while preparing financial statements need to be disclosed while preparing financials. For example, if I am following straight line method, in my financial statements, I need to inform the readers that accounts have been prepared by following straight line. I will also inform that I am following first in first out method for valuation of inventory. These things need to be disclosed in financial statements. Except there is one exception for this. The exception is for fundamental accounting assumptions. Accounting assumptions. There are three fundamental accounting assumptions we have. Going concern, approval, consistency. For every other policy, if you follow, you need to inform. But for these three, it is assumed that you are following. If you don't follow, then only you inform. So what is going concern means? It is assumed that you will run the business for the next 12 months, for the foreseeable future, which is 12 months. So for up to 12 months or more, you will run the business. You don't need to tell in the financial statements that you will run. It is assumed that you will run. If you don't run, then only disclose. If you run, don't disclose. Same way, accrual. Accrual means transactions are accounted when they happen and not when the cash is paid. So, we stay in this property, rent of the property is 40,000 per month. Month end May, even though you have not paid the rent, you need to consider that it is the expense for the month. Whether you pay or not is not relevant. Examples: credit sales, credit purchases, salary outstanding, etc. So, it is assumed that you are following accrual method. If you follow, no need to tell. If you don't follow, inform. The third one is consistency. So whatever policies you follow are consistent. Policies are followed consistently. Right? So if the previous policy is followed, you don't have to inform. For example, our class every day is 7 a.m. I don't need to call everyone and say tomorrow class is at 7 a.m. So it is assumed that the class is at 7 a.m. By any chance, if the class is cancelled or the time is changed, then only I will tell. Otherwise, whatever I have done yesterday is going to be done today also. So, likewise, last year I followed straight line method. This year also I am following straight line method. So, I don't need to explain that I am again following. If I change, then I need to inform that there is a change in the policy followed between last year and this year. So, these three are fundamental accounting assumptions. For fundamental accounting assumptions, if you follow, no need to disclose. If you don't follow, disclose. For every other policy, whenever you follow, you need to disclose. Right? So, this is accounting standard 1 for you guys.